Hey, everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome to 1 Minute Monday. I've been helping families navigate mortgage markets for over 25 years now, and every week I break down the biggest housing and mortgage news in a way that it actually makes sense. So, for those of you who just want to know what time it is, the first minute or so, it's for you. And then for my friends who like to understand how the clock works, we're going to go just a little bit deeper. And then for the real clock builders, we're going to talk about why mortgage rates right now are stuck kind of in a bit of a tug of war between cooling labor market and rising oil prices. All right, now for my friends that just want to know what time it is, here's the headline this week. The labor market, it's actually showing signs of cooling, and normally that would be a really good sign for mortgage rates. Now, the latest jobs report showed the economy lost about 92,000 jobs. Unemployment ticked up to 4.4%, and previous months were revised lower by another 69,000 jobs. Now, that tells us that the labor market, it might be losing a little bit of momentum. Now, on the private side of the data, ADP reported 63,000 jobs added, which technically beat expectations, but most of those gains, they came from small businesses, while medium-sized employers, they actually cut jobs. So the hiring picture, it's becoming a little bit more uneven. Now, normally a cooling labor market, it actually helps mortgage rates because it reduces inflation pressure. But we had another major story hit markets this week. Oil prices spiked pretty darn sharply due to geopolitical tensions in the Middle East and uncertainty around Iran's leadership. Now, oil briefly pushed towards $120 a barrel before settling close to 100 bucks, and that spike actually raised inflation concerns once again. So, mortgage rates are currently stuck between two competing forces: a cooling labor market pushing rates down, and rising oil prices pushing inflation fears up, and, well, rates right along with them. So, as of today, Mortgage News Daily is showing national average rates for top tier scenarios around 6.17 for the 30-year conventional loan, 5.77 for the 15-year fixed, 5.76 for the FHA 30-year fixed, and 5.77 for the VA 30-year fixed. Now, remember, everybody, these are national averages for top tier scenarios, and they often include discount points. So, your actual rate will vary based on things like your credit score, your equity, your down payment, and the loan structure. Now, that's it, everybody, for the what time it is version. Now, before we jump into the deeper explanation, I hope I can count on you guys for a quick favor. If these updates are helping you understand what's going on with mortgage rates and the housing market, please hit that like button and subscribe to the channel. Now, I also want to thank everybody who's been sharing my weekly updates. Your support really does mean a lot. I really do appreciate you. All right, let's go ahead and talk about how the clock works. Now, last week we talked about how oil prices affect inflation, the bond market, and ultimately mortgage rates. So, today I want to build on that just a little bit. And the easiest way to understand what's happening right now is to think about the bond market as, like I said earlier, kind of a tug of war. On one side, you've got a cooling labor market, and on the other side, you've got oil prices rising and inflation fears coming back into the picture. Now, mortgage rates are standing kind of right in the middle of that tug of war. Let's start with the labor market. When the labor market's strong, companies are hiring aggressively, wages are rising, and workers have leverage. That extra income and confidence, it usually leads to more consumer spending, which can then push inflation a little bit higher. And when inflation rises, bond investors, they demand higher yields, and that ends up pushing mortgage rates higher. But when the labor market begins to kind of cool down, the opposite can happen. Hiring slows down, workers have less leverage, wage growth generally begins to moderate. Consumers, well, they become more cautious about what they're spending. And that actually can reduce inflation over time. And when inflation expectations fall, bond prices, well, they typically improve, which can then help mortgage rates move a little bit lower. Now, that's why this week's labor market data really does matter. The Bureau of Labor Statistics, or BLS report, came out last week, and it was pretty darn weak. Now, the revisions were weak, continuing unemployment claims rose, and the average time that it takes somebody to find a job, that's actually increased. Now, even the ADP report, which technically beat expectations, well, it showed that hiring strength, it's not evenly distributed across the economy. And there's another interesting signal in the data. The pay gap between people who switch jobs and people who stay put, well, that's shrinking. And that tells economists that the labor market's becoming a little bit less competitive. And historically, that's another sign the labor market might just be cooling. Now, if labor was the only story this week, mortgage rates would have already improved, but labor data was only part of the story. Oil actually stepped back into the picture, and oil, it's an important one because it can bring inflation fears back really quickly. Now, when oil rises sharply, it actually affects gasoline prices. It affects transportation costs. It affects the costs of moving goods around the country, and it also affects consumer psychology. Now, when people start paying more at the gas pump, they begin to feel inflation again, even if or when other prices are stabilizing. And markets kind of start asking the question, is inflation going to stick around longer than we thought? Now, remember, inflation's like the arch enemy of mortgage backed securities because it erodes the value of that fixed asset over time. Now, that's why mortgage bonds weakened, even though labor data looked quite a bit softer. Now, the bond market had to factor in two opposing forces at the exact same time. Now, let's go ahead and build the clock a little bit here. Now, mortgage rates, they're forward looking. They're constantly trying to price in what the economy might look like several months down the road. So, the bond market, it's basically asking this big question: will the cooling labor market eventually bring inflation down, or will energy prices keep inflation higher for longer? Now, here's the two forces pulling on the mortgage rates right now. Force number one, cooling labor market. The evidence here includes job losses in the latest report, unemployment moving higher, revisions lower to previous months, continuing unemployment claims are rising, longer job search times, and perhaps the most interesting is, like I said, job switchers, they're no longer seeing huge pay increases that they did last year. Now, that tells us that workers have got less negotiating power, which means wage growth may slow. Now, this side of the tug of the war argues that inflation is going to gradually cool and mortgage rates should improve over time. Now, force two is oil and inflation risk. The other side says, hey, not so fast. Oil jumping from around 65 bucks a barrel earlier this year to almost $120 a barrel, that raises the risk of renewed inflation pressure. Now, high energy costs ripple through the economy. Shipping costs rise, transportation costs rise. Businesses pass those costs along to the consumers, and bond investors begin demanding higher yields to compensate for that inflation risk. Now, remember, the good news of mortgage backed securities for investors is that it's a fixed return. That's really attractive when you've got really low inflation. But if you've got a fixed return and inflation continues to rise, you can't buy the same stuff that you used to be able to buy with that same fixed amount of money. That makes mortgage backed securities less attractive during times of higher inflation. And that's why mortgage rates haven't dropped as quickly as some people might have thought they would after the BLS report last week. The bond market's basically waiting to see which force is going to win here. So, what the heck does this mean for buyers? Well, let's go ahead and bring this back to real life. Many buyers are still waiting for the perfect scenario: low rates, low home prices, less competition. And the reality is that that combination rarely shows up because if rates drop significantly, affordability improves. And those buyers that were sitting on the sidelines, they come back into the market and they come back quickly. Now, that increases demand. And when demand increases, prices tend to stabilize or even move higher again. So, real estate, it's historically been a long term wealth builder. As an example, a $500,000 home appreciating at 4% per year, that gains about $20,000 in a single year. Now, that doesn't mean, though, that you go out and rush into a purchase just because of that. It means you make decisions based on long term strategy, not short term headlines. Now, what does this all mean for refinance clients? Well, for homeowners that are thinking about refinancing, this week's a really, really good reminder that opportunities can appear and disappear really, really quickly. That's why I encourage everybody to establish what we call a strike rate. And that strike rate is basically the mortgage rate where the math tells us that it makes sense to at least start having that conversation about a refinance because when rates drop, those opportunities, they may only be around for a short window. Now, for a lot of homeowners, that trigger point is somewhere between a 0.5% and a full percentage point, depending on your current rate, depending on your loan size and other costs. The key is just knowing that number before the opportunity shows up. So, if any of you have not signed up for Home Report yet, it's free, and I'm going to go ahead and put a link down in the description. And we don't share any of your data that comes in from that. So, once you sign up for that, shoot me a text with your current interest rate and how long you plan to live in your home. And I'd be glad to help set you up with that strike rate, at least what makes most sense for you in your specific situation. So, the big picture right now, everybody, the labor market's cooling, which could help mortgage rates over time, but oil prices and geopolitical risks, they're creating this short term inflation concern. And mortgage rates right now, they're currently sitting right between those two forces, which means that the path for lower rates probably won't be perfectly smooth. So, if you're thinking about buying, refinancing, or you just want help figuring out your personal mortgage strike rate, please feel free to reach out. And if this video has helped you understand the market just a little bit better, please like it, share it, or send it to somebody who's trying to decide whether they should wait or go ahead and make a move now. And as always, part of everything that we do at the Shoemaker Loan Team helps support the Home Foundation, where we work to make housing more affordable for our military members, law enforcement, and firefighters in our community. Hey, thanks for watching, everybody, and I'll see you next week on 1 Minute Monday.